Okay, we will get started. Welcome to the 2020 Retirement Planning Considerations webinar. For those of you who don't know who I am, my name is Jenna Witherby, and I'm one of the advisors on the team at 401k Plan Professionals. On behalf of our entire team, first of all, I just wanted to thank you for being here this morning. It is our goal to provide you with value, and we know that you're very busy, so we'll try to keep it short and to the point. Today's webinar is a part of our webinar series. We have 8 scheduled webinars for 2020 of varying topics, and you can catch the webinar live, of course. Otherwise, we'll be sending out the recorded link afterwards via email, and we'll also be uploading these to our website and our YouTube channel. Feel free to save these, share these with anybody that you think might get value from them. If you are a plan sponsor, our hope too is that you share these with your employees as well. So here's what I'll be covering today. This is kind of the time of year where it seems people are reviewing what happened last year and creating plans and setting goals for 2020 and the year to come. So I'm going to cover different ways that you can save for retirement and the new IRS limits for 2020. I'll talk about some notable deadlines, pre-tax versus after-tax savings, and then regarding investments, I'll talk about a couple of fundamentals such as asset allocation and rebalancing. There is a chat feature, so I invite you to ask questions throughout if you think of something. I'll try to remember to pause a couple of times, and then I'll ask for questions at the end as well. So I'm not going to talk about every single way that you can save for retirement. I'm just going to touch on the more common ones that we see. But obviously we work in the 401k, 403b space. I'll talk about that first. We know for a majority of Americans, their retirement plan sponsored by their employer is typically their primary way to save for retirement. And the 2020 limits for 401ks and 403b plans are $19,500. And then if you're over age 50, you can put in an additional $6,500 as what's considered a catch-up contribution. And we get the question a lot, do my employer match dollars or a profit sharing contribution? Does that count towards this limit? And the answer is no. So the limits you see here are just pertaining to the individual's contributions themselves. And then there's individual retirement accounts, both traditional, which are funded with pre-tax dollars, and then Roth IRAs, which are funded with after-tax dollars. Those limits for 2020 are both $6,000. And once you turn 50, you can put in an additional catch-up contribution each year. The 2020 catch-up contribution is $1,000. And we would be remiss if we didn't talk about health savings accounts today. Those are becoming more and more popular as a way to not only save for qualified medical expenses, but also a way to save for retirement. If you are covered by a high deductible health plan, you can save into an HSA account, and there are limits on what you can put in. For this year, if you're covered under an individual plan, the limit is $3,550. And if you're on a family plan, it's $7,100. Once you turn age 55, you can put in a catch-up contribution, and that is $1,000 for this year. The reason why they're becoming so popular as a general retirement savings account is not only can you put the money in pre-tax, you can invest it where it grows tax deferred, but if you take the money out for medical, you can take it out totally tax-free. If you take it out for a non-medical expense after age 65, you just have to pay regular income taxes on it. So it acts just like a kind of a secondary 401k plan, if you will, for a lot of Americans. It's a great tax advantage vehicle. So let's talk about IRA phase-outs. This is a very wordy slide and there's a lot of numbers here, but what I want you to know is that everybody can contribute into a traditional IRA. However, the deductibility may be affected on whether or not you're covered by a workplace retirement plan and what your income level is. So for 2020, if you are single or head of household and you are covered by a workplace retirement plan, the deductibility of your IRA would be phased out if you earn between $65,000 and $75,000 or more. If you're married filing joint and the spouse that's making the IRA contributions is covered by a retirement plan at their workplace, the income phase out is $104,000 to $124,000. And then for an IRA contributor who is not covered by a workplace retirement plan, but their spouse is, then the income phase out is $196,000 to $206,000. So again, a lot of different numbers here, but this is pertaining to the deductibility of your IRA contributions. Roth IRAs also have income phase outs, but this is pertaining to whether or not you can even contribute. So not everybody can contribute in a Roth IRA. For 2020, the income phase out for single and heads of households is $124,000 to $139,000, and if you're married filing joint, it's $196,000 to $206,000. So again, not everyone can contribute to a Roth IRA. So thinking about contributions in general, just a really good rule of thumb that we talk about all the time is increasing your contributions periodically. Everybody is different as far as what system that they have in place to remember to do it, and the amount may vary, but it's a really good idea either once a year, maybe it's tax time, maybe it's the beginning of the year, maybe it's when they have an evaluation, if they get a raise, that's a great time to put more in. Maybe it's whenever they have their 401k meetings at their company. Those are just examples, but it's a really good way to kind of build that into what you do every year. And those differences may not seem like a big difference in the short term, but over time, they can make a really big impact. This on the screen is just an example of somebody who makes $40,000 a year. They have a salary increase of 3% a year, saved for 40 years. They have an annual rate of return of 6%. So if they had signed up for a 5% 401k contribution rate and did that the whole 40 years, yeah, they could very well have, say, $470,000. Had they have signed up for 6%, that would be at $560,000. But here's the real impact, is if you're making those changes year over year. So if they had started at 5% but went up 1% a year until 10, we're talking $880,000. And if they went until 15, we're talking almost 1.2 million. So don't underestimate the impact that small changes every year can make over time. Here's just another way to think about how small amounts can add up over time. So if you look at a $2 vending machine visit twice a week, or a coffee twice a week, or lunch out a couple times a week, had you instead invested that, assuming a 6% rate of return in your retirement account over the course of 30 years, we're talking $16,000, $41,000, almost $100,000. So this isn't to say don't do these things, don't have any fun, but it's more the point of save for retirement, pay your future self first, and then do those extra things. Or maybe you can reduce the amount of times that you do these extra things on a weekly basis. So I talked about the power of health savings accounts when it comes to saving for retirement. And this is just an example, but the big thing is that health savings accounts have triple tax savings. You can put the money in pre-tax, you can invest it just like a 401k, typically in mutual funds. Once you have usually over $2,000, you can start investing in different mutual funds. So you can have tax deferred growth on the money, and then you can take it out tax-free if you use it for qualified medical expenses. That's why you hear the term triple tax savings. Like I said, after age 65, if you take it out for non-medical, that's okay. You just have to pay regular income taxes on it. And this is just an example, but it's assuming somebody made the maximum family contributions into the HSA for 15 years, and they invested the money, assuming a 6% annual rate of return. At retirement, or at the end of this 15 years, they have about $195,000 in this account that can be used tax-free to pay for medical. So just that in and of itself was a savings of $29,000 from taxes. So don't, not everybody qualifies for HSA. I understand that, but don't dismiss the power of HSA accounts. Okay, let's talk about some deadlines. So a triggering event for a required minimum distribution last year was if you're retired and you're 70 and a half or older. So anybody who needed to take an RMD for 2019, the deadline was December 31st, 2019. But if it was your first year having to take one, you really have a grace period of until April 1st of this year to get that taken care of. April 15th is the deadline for 2019 IRA contributions. April 15th is also the deadline for employers to make contributions unless they file a tax extension. And then this year, December 31st, is the deadline for any 2020 required minimum distributions. Unless it's the person's first one, then they get until next April to do it. And a little caveat here, the RMD age changed. So effective 1/1/20, the RMD age actually went from 70 and a half to 72. So going forward, that's the triggering age. Now we've been getting this question, if I had already started RMDs in 2019, do I have to continue? So you might be age 70 or 71, do I have to continue? And the answer is yes. And by the way, we're gonna be doing a webinar in February all about the Secure Act that just passed at the end of December, which changed the RMD age and a number of other things for retirement accounts. I just had the question come in, what is the deadline for HSA contributions? And then yes, it's April 15th. Some employers will let you make your HSA contributions through your payroll, but you as an individual can certainly, up until April 15th, fund it with your own dollars. Great question. Okay, so let's talk about pre-tax versus Roth contributions. And really the main difference is whether you pay taxes now on that money or at the time when you withdraw the money. Roth is certainly gaining traction. It wasn't very common 10 plus years ago when it first became available inside 401k plans, but now it's definitely more mainstream. Why may someone consider to do Roth contributions? If you think your income will be higher in retirement, if you think your tax rate will be higher in retirement, overall, if you just desire more tax diversification, just the ability to have different types of money to draw from in retirement, we hear that a lot too. And remember, back to the Roth IRA limits and the income phase outs, not everybody can save in a Roth IRA. So Roth 401k may be attractive to some people. I just got the question, what if I want to save with Roth 401k dollars? Do I have to open a separate account? And the answer is no. It's actually very simple for you to save with Roth dollars inside your 401k because you still have one 401k account, and then your provider or the vendor tracks within that the different types of money that you have, or in other words, the different buckets of money. I did have another question come through. Can you pay health insurance premiums with your HSA? And yes, you can. Yep. Okay, asset allocation and rebalancing. I wanted to touch on these couple of fundamentals. They're always great reminders. Again, this is kind of the time of year where people might be reviewing things and thinking about their future. So asset allocation is a technique that tries to balance risk or lower your risk, manage your risk by dividing your money among different asset classes. So if you've heard the term, spread out your money, don't put all your eggs in one basket. And for us, our goal is to really be proactive when it comes to managing risk with your investments in your portfolio. We feel if you are invested properly for your age and your risk tolerance, you should be able to remain calm if and when volatility arises. And rebalancing should be done periodically to stay near or at your intended allocation. You can do this manually, or a lot of providers, a lot of websites will let you set it up automatically. And these circles on the bottom are just an example, but let's say somebody said, okay, I want 4 investments, I want 25% in each, but over time, a couple of them perform better. So instead of being the even 25% across the board, let's say a year or two later, it turns into 23%, 20%, 30%, 27%. What rebalancing would do is it would sell off some of those better performing investments and it would buy in the other ones lower. So it would bring you back to that even 25% into each. This just kind of talks to when we are trying to explain to somebody or educate on the importance of keeping your time horizon in mind with investing. This is kind of looking back in time, and we can show why we say what we say. If you have shorter time horizons to invest, you may not want to have as much exposure to equities, to the stock market. And this chart is looking at 1950 to 2017. You can just look at the green. That's a portfolio fully in stocks. It's looking at the S&P 500. But if you were on the left-hand side, if you were to look at 1 year slices in time, 1 year slices in history, you can see a lot of volatility there, right, in the stock market. And even on a 5-year basis, quite a bit of volatility. But over on the right-hand side of the chart, for a 10-year rolling time frame, a 20-year rolling time frame, you can see a lot less volatility. In fact, for any 20-year time frame or longer, stocks have not had negative performance. So our viewpoint is the longer your time horizon, you should be able to have more in the stock market from a comfort level. But if your time horizon is, say, 1, 5, 10 years, you probably don't want to take on as much risk. So this is helpful for us to just kind of describe why we say what we say. Diversification is very big. It's another way to manage your risk. This is a chart showing the 9 different sectors of the US stock market, and you notice no sector does the same as any other sector over any given period of time. And so since we don't have a crystal ball and we don't know what's going to perform the best this year or this quarter, it just really speaks to why you want to be diversified and make sure you're capturing investments in different sectors. This slide is always so fascinating to me. It speaks to the importance of staying the course, even through those times of short-term volatility. Trying to time the market is extremely difficult to do. When the market is going down or we're having a lot of volatility, that often results in emotional decision making. But investing more for the long term, looking at the big picture and making small changes over time, that usually results in a better retirement outcome. This chart is just an example of a $10,000 investment in the S&P 500 from January 1999 to December 2018. So those that 20-year time period. And if you had remained fully invested in the S&P 500 during that time, we are looking at a 5.6% annual rate of return. And here's the fascinating thing. If you miss just the 10 best days in the market over the course of that 20 years, your annual rate of return is all the way down to 2.01%. And if you miss the 20 best days, it's actually negative, and you can kind of see how it goes. So that is why we educate very strongly on staying the course, not trying to time the market. Just like I said, trying to be proactive with investment allocations and making sure that you're appropriately managed for your age and for your risk tolerance. Okay, so this is what I had covered, new ways to save and the new 2020 IRS limits, some notable deadlines for you, pre-tax versus after-tax contributions, and some considerations when it comes to investing. There's different ways to get access to this webinar and other webinars that we've done in the past. Everything is uploaded to our website, www.401kplanprofessionals.com. You can also go to our YouTube channel, so you can search for 401k Plan Professionals, and you can even subscribe, so then you're notified every time we do a new video. We get the questions quite a bit from plan sponsors who say, you know, I want to put your content out. What's the best way to do it? You can certainly forward it on. And another way to do it is if you want to provide us with a list of email addresses. We can certainly push that out to your employees. We have a number of clients that decide to do it that way. Whatever is easiest for you, it really makes no difference to us. Thank you again so much for your time and for being with me this morning. Our next webinar, like I mentioned, is going to be in February, and we're going to cover all things about the Secure Act that was just passed at the end of December. So thank you so much, and I hope you have a great rest of your day.